maybe today is the day that you are going to start investing. It is Tuesday today, and you're going to buy your first stock. You've been eyeing a stock for a very long time, and today is going to be the day that you're going to buy it. But before you go ahead and do that, you need to listen to this episode because today we're going to tell you that it's actually possible to find out what is a good price for the stock. Because if you buy it today, you might actually buy it when it's really expensive. So stay tuned. Listen to today's episode. You're listening to Investing Mastermind Podcast. My name is Signe Lonholdt.
And I'm Michelle Marki.
So what we want to share with you today is something incredibly important, because the mistake that a lot of new people that are new to the stock market, new to investing, what they do is that they go ahead and decide today is the day, and then they just purchase a stock. But what they can end up doing is to actually overpay for this stock. So were you aware that you can actually pay too much for a stock? Maybe this is a new concept to you. The name of this episode is Margin of Safety, because it is this margin that Warren Buffett uses to ensure that he doesn't overpay for stocks. When you heard about this concept for the first time, Michelle, I don't know if you can remember, but was it groundbreaking to you, or did it make sense? Did you think, yeah, I don't know if I believe that? How was it for you to discover margin of safety?
It seemed fairly logical. I learned from an investor who studied Warren Buffett and Charlie Munger named Phil Town. And Phil Town explained it in such a way where you don't want to pay full price for a company, like whatever it's trading at in the stock market, you want to buy it at a discount. So if you can get a discount to what it's trading at, like it could be fairly valued in the market, it could be overvalued based on some calculations that you do using earnings and other figures, you can figure out what could be a good discount to its fair value. So there is a certain way that we can go about it. We won't go too deeply into how you calculate margin of safety, because there are many materials that you can learn and study on how to perform the exact calculation. But we want to make this episode more about stories and how we generally get the concept. And also what I learned from the late Charlie Munger is an idea of how to think of margin of safety is that it's an engineering concept where when bridges are built, they're usually rated for a certain amount of weight that a truck or vehicle can go across a bridge. And we often see signs for this, like there's a certain amount of tons that a truck shouldn't be over when crossing a bridge. And that's what's considered to be a margin of safety, is a bridge was built in such a way that it can hold way more weight than most trucks are going to weigh. And if a truck is anywhere close to weighing that amount of weight, then they shouldn't go on the bridge, because then the bridge could be vulnerable to collapsing if too much weight goes on the bridge. So that's one way to think of margin of safety and try to apply that to a stock. Like if you go over the price that is reasonable discount to the fair value of a stock, you could risk that you paid too much and you might not get to realize the full value of a stock if you pay too much for it. So that's why it would be ideal if we could get a margin of safety or discount to what we believe is the intrinsic value of a stock.
Yeah. And so one thing, I know that podcast, you can listen to this podcast whenever, maybe you're listening to it years from when we actually recorded it. But if someone came to you today, Michelle, and said, hey, I'm ready to invest, I actually, later today, I'm going home and I'm going to buy my first stock. What would you say to this person if today, the day that this podcast is recorded, what would you tell them if somebody would come up to you, like a colleague or friend, and be like, hey, Michelle, I'm so excited. I want to share this with you. What would you tell them?
Well, I'd probably tell them, get the book Invested by Danielle Town and study up on how to do margin of safety calculation before you were to buy a stock today. So whether you borrow her book from the library or buy it online, wherever you get your books, try to look at how the Town family described margin of safety and follow their instructions before you were to invest in a company. That's what I would say to anyone who would like to invest right now is like wait and study and then see if your calculations reveal that a company is worth buying, maybe tomorrow, maybe in some amount of time from now.
Yeah, well, that is great advice, Michelle, to actually, because like we also mentioned, it's too maybe too complex for us to tell you exactly how you calculate it. So go read the book before you start investing. And I know that maybe you had thought that you were going to go buy your first stocks today, but it's going to be so incredibly beneficial to you to actually be able to calculate that price because you don't want to overpay. Many people have been in that situation where they were not aware that you could actually calculate a reasonable price for the stock. So they just bought it at whatever price. And then soon thereafter, there was only way down on the stock. And they didn't understand how come the prices not have been increasing. I saw the chart. I saw it was increasing for years. So how come it's not increasing now? Well, the answer is you probably paid too much for the stock and it's, now come down to a more reasonable level. So that is why, it's so important to actually understand this concept. But, once you understand the concept of and are able to actually calculate margin of safety, so go read the book and calculate that margin of safety, because what will happen instead is that the other scenario that you're going to experience is that you're going to buy at a reasonable price. And then what you will see is that the stock over time will increase and go back to, a higher level if you buy at that margin of safety price. And that's the beauty of this system. It goes back to Benjamin Graham. Warren Buffett learned it from his mentor, who was called Benjamin Graham. And it was really, a central principle in Benjamin Graham's strategy. He bought stocks at the time at, this cheap price all the time. That's all he did. So Warren Buffett doesn't necessarily only buy, he doesn't look at, oh, as long as it's cheap, I'm going to go buy. Warren Buffett also look at that quality element and, Munger's thoughts about actually a company had to be quality. So go back and listen to some of the prior episodes to actually find out, is it actually a quality business? We talk about that in the two prior episodes to this one. So it's a central principle. My own experience is that when I stick to the system, when I buy at a margin of safety, a quality company at a margin of safety, it goes well. So, it really, really goes well. I have amazing returns when that happens. So I am one of those people. I follow the system to a T. And I rarely buy anything that's too expensive. I don't do that anymore. I used to do that sometimes, but I actually don't do it anymore because I found out if I just follow the system, that's going to be absolutely, it's going well for me. So that's what I have to say about margin of safety. It's a principle I use. How about you, Michelle? Do you use the principle or do you use it sometimes? Do you use it always? How do you go
Yeah,
about margin of safety?
I've used it sometimes. I haven't been as frequently using it recently just because I've been busy with other things in life, but I try to use it. And I also keep in mind the late Charlie Munger, who was known for saying it's better to buy wonderful companies at fair prices than fair companies at wonderful prices. So, in a way, that's a little bit different than what Benjamin Graham had focused on because he was focused on getting fair prices, but he didn't always check that they were wonderful companies. So sometimes it was a fair price for a fair company instead of a wonderful company, as Charlie Munger had emphasized. So that's also what we want to keep in mind. We don't want to just buy a mediocre company. It should be a really important company that if you've listened to some of our previous episodes on the meaning, like, is this company meaningful to you? Does it have a moat? And does it have good management that has integrity? So when you factor all these in, you might arrive at a wonderful company that you could hopefully buy at a fair price someday. And keeping that in mind, I've sometimes used the calculation, but also done some of the wrong behavioral move as well. So a few years ago, I had used the margin of safety calculation to arrive at a good price for Google stock. And I bought some Google stock at roughly that valuation. But then what Google proceeded to do is go down in the stock price. And I felt miserable about it because I thought I made a mistake of my margin of safety calculations. Even though I thought I was buying at a discount, it went down even more. And emotionally, that was difficult for me to handle because now I thought, did I do a wrong calculation? Should I have waited to buy this until it went down more? But how could I have known it was going to go down more? And I could have 3x'd my money on Google, and yet I missed out because I got afraid of AI, and I thought AI was going to threaten Google, according to some of the news. And I let that fear get to me and cause me to sell Google. So I deeply regret that. So even though I thought I did my homework and I thought I did the margin of safety calculation and arrived at a fair price for Google, which is a wonderful company, or also known as Alphabet, I gave in to emotions, and that was the wrong way to go about it. I should have just held the stock because now it's done so much better years later and has come up with its own AI tools. So that was a lesson for me to learn of to keep faith after even having done the calculations. Don't second guess myself next time I do margin of safety analysis and have done other homework on a company.
Yeah, and also another thing I'm gonna take away from here is, or from your story, is that even though that a stock is trading at a margin of safety, it can still go even further down because the margin of safety is not, that's not the bottom price. We do not know when a stock is gonna hit a new bottom, so to speak, right? When the price is just gonna continue to fall. That's simply humanly impossible to figure out when has that price hit rock bottom because it's got to do with human emotions. So some of the sellers out there are going to push that button to sell the stock, and it's just impossible to figure out. So even when you calculated the margin of safety, yes, it's so important to say that the stock price could still continue to go down. And what Warren Buffett says is buy more, do the way he says is, if you can get a hamburger at a discount and then a couple of days later it's even cheaper, why don't you go buy that? Of course you would go buy that hamburger had it been, a real life scenario. So that's something that you can actually do. One of my stories, one of my mistakes, I'm also absolutely willing to share, is that I had been looking into a business. I had kind of, looked into the management and the mode, and I had some of the data, but I was a little bit lazy at the time, so I hadn't really been doing my homework and studied the company into detail. So at some point, there's an event happening. The company is, getting sued by a lot of the shareholders. So the stock price falls because it makes the news, and some people become fearful and they start selling the stock. And the price hits the margin of safety that I've calculated. But instead of clicking the buy button, I got scared a little bit, like you said, I became fearful because I didn't really feel I knew the company that well. I was like, is it still a good company? I should have done my homework even better. So I did not hit the buy button at the time. And since then, I've come to regret it so many times, and I haven't been able to purchase that company because, it's just gone so well for the business after that, and the court case was soon forgotten and all that good stuff. So, there's sometimes where you haven't done your homework well enough, then you can still get scared and not jump on these opportunities. So that's kind of so important to also remember some of the things we've been talking about in prior episodes in order to actually, when it's time to buy, that you have the confidence to also do it. And speaking about all these emotions, Michelle, I think in a future episode, we should be talking about some of the things that you will experience as a Buffett style investor so that okay, because there will be emotions, right? It's
Yeah.
not like this system will just take away all your emotions.
Absolutely. And that's why it's so important to stick to the system like Signe does. And to, as
Yeah,
much
I
as
do that now.
possible,
Stick to the system. Yeah.
yeah, even if you're feeling all these kinds of emotions and you're doubting yourself because as soon as you buy the stock, it went down in price and you're like, hitting yourself on the face because you're like, I can't believe I bought this stock and it went down and did I make a mistake? Like it's easy to second guess yourself, but if you have practiced this discipline and if you've learned enough from your mistakes, sometimes no amount of theory can make you learn. You have to go through it yourself, make the mistakes and learn and just try to do better next time. Like nobody's a perfect investor, not even Warren Buffett. So we all make mistakes, but it's more like how can we learn and try to avoid making those mistakes next time? That's the most important key. And, it will happen, but you can't get too down on yourself. Like no matter where it is that you may have slipped up, you just have to pick yourself back up, try again, and try to study something. And remember, something that Signe emphasized to me is to focus on a quality business. Maybe I didn't do enough of my homework to keep in mind, after all, Google is still a quality business. I shouldn't have gotten easily shaken up in my faith to think AI was going to destroy and take down Google for good. That was just overall market fear at the time. And it was just silly to look back in retrospect, knowing that Google is a quality business. So if we keep those factors in mind, we can have a better ability to maintain our investments and not just run for the hills at the slightest doubt that someone might be putting out there.
Yeah, exactly. So, having the system and go back and listen to the prior episodes if you haven't already listened to them, because having that system can give you so much certainty and faith in yourself. And actually, so you're ready to take that step and also make good, sound investment decisions so that you're not throwing yourself out there in the stock market, potentially, losing your money. That's what we don't want to lose our money in the stock market, and that's why we do these things. It doesn't have to be that complicated. This might be the first time you hear about this and you think, oh my goodness, this sounds so complicated. It isn't necessarily. It's just, actually learning about the system, and that's the first step. So it's great to have you here and that you're open to learning the system. And we'll be, sharing so much with you in the, episodes, and we've got some really great content for you planned. So, keep on listening and learning through Investing Mastermind podcasts. So we hope that this episode, once again, that you have learned something, that you know your next step. Go read the book, as Michelle said, and go calculate your margin of safety so that you are absolutely ready to invest in a wonderful business. We'll be back in 2 weeks from now.
Till next time.
If you enjoyed the show and found the content informational, we would be super grateful if you would leave us a review and follow us wherever you get your podcasts so you automatically get new episodes in your feed.
The contents of the Investing Mastermind podcast are for educational, informational, and entertainment purposes only. None of this is investing advice, and if you need help in your personal situation, please consult with a professional.